Welcome, everybody. I'm John Momartz. I'm here with Bob Key. We are sitting here on May 16th. We are going to give you a brief economic update on where we see things stand today. Today's agenda, we're going to talk about, is this a bull or a bear market? Talk about selling stocks, history of panic attacks, recessions. We're going to talk a little bit about what the current earnings were for Q1. Talk a little bit about inflation, the job market, individuals' credit situation, household credit situations, and a little bit about what the Fed is doing right now. So without further ado, Bob, do you want to take it from here?
I do. Thank you, John. So this is simply a chart of the S&P 500. We sold off about 25% since the start of 2022. We bottomed in October of 2022 and have since bounced. Right now, if you survey economists and market pundits, you'll find that a slight majority of them believe this is more of a dead cat bounce than a bull market, and that this current bounce is just it's a small period of an up movement, but then it'll otherwise resume its down movement. We continue to believe that it's the start of a new bull market. Historically, if we go back and we look at bear markets, there's been plenty of them. Relatively speaking, this bear market has been a very mild one, 25%, and it was only 10 months. So relative to true catastrophic downfalls where we lose 50% and they last for many years, if this is indeed the start of a new bull market, this bear market will be considered a very mild one. One of the things we like to talk about with this is the certainty that people place around it. If you went and you looked at these surveys back when COVID-19 came out, the vast majority of economists, were certain that we're going into a deep recession and that this would be horrible for stocks. One of the things we'd like to point out is that when you look at these markets and you look at the data, what we always have to remember is that when it comes to these sort of external type of shocks and not economic events, we really have very little forecasting ability in these because we don't know how agencies such as the Fed and the federal government, for that matter, with fiscal policy, are going to behave. So it's just always a good reminder when we think about all these headlines, the different meltdowns we've had or corrections we've had over the years. The corrections we're going to get to in a minute shows sell-offs of 10%, but not more than 20%. You can see, here's right in the middle of the latest bull market. 2014 was a great year, but we had several corrections, 5, 10 plus percent. And a lot of the, we look at a lot of the events that created them, and we tend to the headlines, although they're big at the time, tend to subside over time. So the difference between a bear market and a correction is corrections are usually based on uncertainty and doubt and fear in the world. Bear markets are based off of recessions. It's hard to have bear markets without recessions. This latest bear market we commented was a very mild bear market, assuming this is the start of a new bull market. And it was not accompanied by a recession, which is very, very unusual. The only period that really we can find that it was like that was in 1987. They had this very quick sort of downswing in markets. There was not a recession, and then it continued higher. So we'd like to continue to look through to the economic data and try and stay away from the headlines. If there is a hard landing, if this recession does come through, it is going to be the most widely forecasted recession of all time. There's been forecasts for a severe recession now going on 3 years. Once again, Q1 disappointed the bears and disappointed the recession forecasters and came in slightly positive. Q2 GDP is once again, real GDP number forecasts are positive. So this recession, you find a lot of the economists just keep kind of pushing it back each year. So the 2021 recession did not happen. They moved to 2022, then to 2023, and now they're starting to move to 2024. And then you look through the deeper numbers, things such as real final sales are doing just fine. So the economy seems to still continue to be fine at this point. when you're buying stocks, and we're talking about bear markets and corrections and what the difference is, what you're really buying when you buy a stock is you're buying that stock's earnings. So one of the things we always like to look at is just, okay, well, how are these earnings doing? Well, Q1, we're into Q2 now, so Q1 earnings are mostly reported. And 76% of the companies out there beat the expectations that were set forth by the analysts for the Q1 earnings. Not only did they beat them, but on average, they beat them by about 7.8%. So earnings continue to be very, very good for these companies. And there's something that, digging down deeper here, right? Earnings is your revenue minus your expenses. There's been a lot of talk about higher labor costs and what it's inflicting upon the earnings of companies. Well, there's some truth to that, but even with that, as of now, they're able to be passing this on to the consumer. So you can see that earnings are doing just fine despite the higher labor costs that are out there. Consumer price index, widely used as the indicator of broad inflation. A year-over-year change, right? We peaked close to 10%. Now we're down at about 5%. The 3-month trend is at 3.8%. Inflation definitely seems to be coming down in all areas, with the exception of services. Again, digging deeper into services, a lot of the services numbers coming through, it's what they call rent or owner equivalent rent. Housing seems to still be holding that up some, along with employment. Unemployment rate is at 3.5%. Most of us, if we go back and we think about all of our schooling and all that, we're always told the frictional rate of unemployment is 6%, meaning that just because people moving between jobs, things are going on, etc., 6% was effectively 100% employment. We're at 3.5%. That number is way through what they would call the frictional rate of unemployment. It's unambiguously saying that anybody who wants a job can have a job. Why we say that is, if you look at the American consumer, if they are employed and they are making money, they will spend money. So for all the sophistication of this, we've heard lately about some banks starting to struggle, etc. They've brought it up to sort of that very edge of where you're slowing consumer demand as you meant to do, you're tightening credit as they meant to do, and you're not breaking the system. We can go into 1,000 different statistics, but one we'd just like to say with the Fed is, if they continue tightening, we will have a hard landing. If they stop now, we believe it will be a soft landing. And this is the Fed rate cycle that we're talking about. You can see that following rate hikes, that's the blue line, you see those blue shaded areas are recessions. Recessions typically follow about a year or so after the Fed is done hiking. We don't think that's going to be the case this time. We think we're going to be fine, because if we look at the amount, when the Fed hikes, what they're really doing is they're trying to contract the amount of credit out there. The difference between this and the prior ones of 08, 09 is that there was an enormous amount of debt out in the system. Because of 08, 09, tighter lending standards and regulations by the federal government have created too much debt from being created. So debt levels continue to be very low for the American consumer, as this debt service ratio shows.
So with that, I will mention that fortunately last week, Bob and I both had the opportunity to meet with current and former Fed governors to hear their take on the economy and listen to what they're seeing with their surveys. And all in all, they do see a fairly strong economy, but we do believe that they are near or are done with the tightening. And we are hoping that they are, and that we can have the soft landing that we are predicting, and we can see stronger markets going forward later into the year. But with that, look forward to seeing all of you in the near future, and have a great day. Thank you.
Thank you, everyone.